Good evening, ladies and gentlemen. You're very welcome to this evening's discussion of credit spread risk in the banking book, which you're probably aware is very much a live issue in the area of ALM. I've called this, or I've subtitled it, Lessons from the European Experience, because the European Union is probably the regulatory area that has gone furthest in terms of putting a regulatory and supervisory and indeed reporting regime in place around credit spread risk. I wouldn't say Europe is at the final line yet, the finishing line, and I would expect a further round of direction and guidance from regulators, either the ECB or the European Banking Authority sometime this year. So, here's a pretty general definition. Credit spread risk in the banking book refers to the exposure of a bank's financials to movements in credit spreads, excluding exposures to the trading book and exposures captured elsewhere, which in particular can refer to spread risk in defined benefit pension books. When we talk about financials, we really mean the capital of the institution and, exposure of that capital either through, as we will see, through net interest income or through fair value changes. Credit spread risk has been a major focus of attention for banks and regulators following the global financial crisis. In 2016, the Basel Committee in its CSRBB standards dealt in fairly brief terms of credit spread risk in the banking book. There were really only a handful of statements there. But what Basel said was that it was a related risk that banks need to monitor and assess in their interest rate risk management framework. Now, even though there's only a handful of statements within the CSRBB standards, they're somewhat problematic. Basically, Basel defines the scope of credit spread risk in quite ambiguous language. And secondly, it proposes to measure credit spread risk using a concept of systematic credit spread variation as opposed to movements in total observable spread. And many banks believe this is impractical to implement, if not also difficult to understand, as we will see. Now, although the Basel Standard is the original source document, as I said, most of the regulatory action has happened within Europe and has been driven by the European Banking Authority through a consultation process and finally detailed guidance issued in October 22. Now, those guidelines cover both CSRBB and credit spread risk, but they deal with credit spread risk in much more detail than the Basel document of 2016. And then finally, the ECB has also recently introduced detailed quarterly reporting, which I think will be the basis of, the next round of regulatory guidance in this area. Now, these new guidelines have also been controversial, mainly because they interpret the Basel definition of credit spread risk much more broadly than banks do internally, while at the same time giving banks limited guidance on how to comply with this broader definition or this broader scope. And that has been a considerable source of frustration to banks. But on the plus side, the guidelines, the EBA guidelines, allow banks to measure credit spread risk with respect to movements in total spreads, or indeed, so you can implement either the Basel systematic measure that we referred to in the previous slide, or you can measure exposure with respect to total spreads. The EBA is also strong on governance and is clear on the requirement of credit spread risk to be subject to limits and to come within the risk appetite process and within the ICAP process. So they're very clear that credit spread risk should be subject to capital capital allocation, Pillar 2 capital allocation. Now, the ECB, as I mentioned, has introduced very detailed quarterly reporting on banks' internal modelling of credit spread risk, and that took effect from December 23, and indeed the first returns were submitted in late February. You can actually see the template on the ECB website if this is an area you want to look at in more detail. But this quarterly reporting will provide a large volume of data and qualitative technical information that will tell us how banks are interpreting and applying the EBA guidelines, provided, of course, the ECB release information or summary information as to what the returns say. But I would expect, and I think many people expect, that those returns, that information, if it is published, will highlight a significant range of practices in this area and an issue of consistency as between different banks' interpretation. So, as I said, depending on the content of these returns, the ECB may become more prescriptive, more directive, if you like, on the internal model of credit spread risk to achieve greater consistency across banks. So this evening we're going to outline the approach taken by the European Banking Authority to the measurement of credit spread risk and highlight how this differs from the industry perspective on the nature of this risk. Suggest the lessons to be learned from the European experience when it comes to in Latin America, when it comes to banks engaging with their supervisors as to how this should be measured and managed. And then finally, make a few brief points just in relation to how corporates may also be affected by these regulatory decisions around credit spread risk, which of course only apply to banks, but could have some indirect consequences for corporates. And the time available, we don't really have time to get into technical measurement issues, but if it's an issue, if it's an area that interests people, I've included an appendix to these slides, which will circulate, and that sets out how you would apply value at risk, 1 year value at risk, as opposed to 1 day value at risk or 1 week value at risk to credit spread risk. I think it's worth just looking very briefly at the way the institutional structure of regulation and supervision in Europe. Basically, as you know, Basel writes the global standards, and then the European Commission converts those into European law in the form of regulations and directives, usually with amendment, and those are submitted to the European Parliament to be approved. Those regulations and directives, generally speaking, direct the European Banking Authority to write detailed implementation and supervisory documents on particular areas of regulation. The EBA writes these into form of guidelines and regulatory technical standards. Those in turn then get passed to the European Central Bank, which is the supervisor for the Eurozone, and then it is passed directly to other regulators in the case of countries that are part of the European Union, not part of the Eurozone. We refer to 3 documents today. The first the first 2 we've already discussed, the IRRBB standards in April 16, which deals, as I said, in fairly brief terms, but nonetheless significant terms, with credit spread risk. We then have a document that's generally referred to as the guidelines on IRRBB and credit spread risk by the European Banking Authority. Its full title runs to about a paragraph, as you can see there. I won't read it out. I suspect it was probably written by a German. And then finally, a document from the European Banking Federation that is an industry representative body, and that the EBF wrote a paper on credit spread risk in the banking book, in effect saying this is what the industry believes are the requirements in this area. Do you, the European Banking Authority, agree with this? It wasn't a document that got I think the response they were hoping it would get, but nonetheless, it's a significant statement of banks' understanding of what's required. We will also refer, indeed we have already referred, to the ECB's quarterly credit spread risk reporting template that came into effect on the 31st of December last. Now, prior to the global financial crisis, banks recognized that they were exposed to movements in spreads arising in bond books, which are classified as available for sale, and also certain fair valued liabilities, such as structured deposits, to which DVA applies. But banks generally ignore this risk because spreads move so little. And the great financial crisis changed all that. Indeed, in many respects, we can think of the global financial crisis as being a crisis of spreads, in that you have a big blowout in LIBOR OIS spreads, you had movements in CDS spreads, You had cross-currency spreads blowing out, you had CVA values blowing out, and indeed, in many cases, the largest losses that banks recorded, point-in-time losses that banks recorded, were not as a consequence of default, but as a consequence of spread movements. So it's not surprising that following the crisis, banks, regulators would focus on this particular area. Today, bonds that are fair valued through other comprehensive income are overwhelmingly securities held as high quality liquid assets to comply with the liquidity coverage ratio. In most cases, home country sovereigns are the largest concentration in the HQLA book, along with other sovereigns, agencies, covered bonds, and other highly rated paper. Just a point of clarification, when we talk about spreads in the context of a HQLA book, we're really talking about asset swap spreads, which is essentially the gross redemption yield minus the swap rate. And of course, a bond doesn't have to be swapped to be viewed as a spread to floating, except of course that spread will vary continuously with movements in bond yields and movements in swap rates. Sovereign CDS can also in principle be used for modeling purposes, but just be aware there can be significant basis between asset swap spreads and credit default swaps. Again, from a European perspective, it's worth reminding us that 5 EU member states went through significant sovereign stress, or indeed full-blown crisis. Greece defaulted. Initially, Ireland, Portugal, and Spain were bailed out. And indeed, sovereigns that didn't go into full crisis experienced what for them was significant material spread widening, and France is notable in that regard. The graph on the left there shows you peaks of about 500 to 600 basis points in terms of asset swap spreads. For Italy and Spain, those are probably something, I don't recall exactly what I used there, but probably something like 5 or 7-year bonds. And then on the other side, see that Ireland, my own country, experienced credit spread widening of up to 1,100 basis points immediately before the Irish bailout. So the regulatory approach to the measurement of credit spread risk in the banking book. Basically, the Basel standard for RBB, published in 2016, define credit spread risk in the banking book as any kind of asset liabilities, spread risk of credit risky instruments that is not explained by RBB and by the expected credit or jump to default risk. Now that is quite a vague definition, and it is the only sentence in there that defines it. There's no further discussion of it. There's no points of clarification or elaboration. And we'll see as we discuss this that the vagueness of this statement has not been helpful. Now, the definition is qualified in 2 respects. First of all, the gain from a widening of the bank's own credit spread risk cannot be part of a measure of credit spread risk in the banking book. And that's simply consistent with the way regulatory capital is measured. The bank's regulatory capital cannot benefit, as you probably know, from a deterioration in a bank's own credit condition, credit circumstances, and from the widening of debt capital as a consequence of that. And then finally, it says that fair value credit risky assets must be included within a bank's measure of credit spread risk in the banking book. Again, that's not a controversial statement from a bank's perspective, because these are precisely the line items that a bank expects to see within credit spread risk in the banking book. Now, Basel and the European Banking Authority state that banks should measure credit spread risk in the banking book as exposure to variability in the systematic price of credit and liquidity risk, which should exclude exposure to spread changes on individual obligors driven by credit migration up or down and by default. Now we try and explain what Basel and BVA are getting at in a moment. Essentially, Basel and the EBA use the graphic that you see there to explain their concept of credit spread risk in the banking book. And really you can think of this as applying to a floating rate note or a fixed rate issued swap to floating. And basically what Basel says is the spread on an instrument such as a bond or a floating rate note can be, the changes in the spread we can think of as driven from four different places. First of all, and this is really my reading of the Basel document because it's not terribly clear. First of all, they can be driven by changes in high-level global credit spreads. So movements in global credit spreads as a consequence of sort of high-level credit conditions. Secondly, changes in the spread can be driven by changes in market liquidity conditions, which can cause spreads to move in or to widen or tighten. We then have two sets of idiosyncratic risks, so sectoral effects, or geographic effects, and currency effects can also cause credit spreads to move. And then finally, we have instrument or borrower specific elements, which can also cause credit spreads to move. And basically, what Basel says is, the systematic component, so changes in global credit spreads and global credit conditions or liquidity conditions, is the systematic component. And this is the component we want you to, this is the component we, the regulators, want you banks to apply when you measure movements in these components is what we want banks to focus on when they measure credit spread risk in the banking book. Now, I think you can already see this, some challenges in terms of implementing this. First of all, these components are unobservable. All we can see is the total spread. So the question is, how do we go about decomposing it into these four elements? And unfortunately, Basel and the EBA offered no guidance on how to do this. Secondly, sectoral, geographic, and currency effects are usually considered systematic factors, not idiosyncratic factors. So that's rather unusual. Secondly, you can really ask, is this approach actually suited to sovereign risk, which would be a large part of the asset side? Does it make sense to think that there is some sort of global credit spread factor that can drive, let's say, sovereign spreads in Germany and Nigeria, for instance? Most of us would think that that is not plausible. So there's a real question mark as to whether this is even applicable to sovereign risk, which in many respects is idiosyncratic risk. It's very much related to the economic circumstances and the policy positions taken up by the sovereign concerned. Although we do observe geographic contagion in the case of sovereign crisis. We saw it in the case of the European markets, and those graphs we looked at earlier, but also I think it's been a feature of similar crises in Latin America. Let me just take a look at the chat box here. Yes, I agree with that. Yes, so there will be time for questions at the end, but if you want to put questions up, assuming I spot them, sometimes I don't spot them, but assuming I do, I'll try and answer them. And then finally, assuming we believe that it's possible conceptually to break spreads down this way, we still need an index. We still need data that represents Basel's concept of the market credit and liquidity spreads. So there's quite a bit of pushback from banks in relation to this, essentially saying it's conceptually questionable and it's very hard to know how we banks should go about doing this. Now, following pushback from banks, the EBA guidelines in October 22 appear to allow banks to opt out of this approach and measure credit spread risk with respect to movements in the total spread, provided the measure is at least as conservative as applying the Basel definition. Now, I won't read this paragraph top to bottom. This is essentially what it says. However, there are some words here that would give you cause for concern. First of all, it talks about as an exception, banks can do this, can work with total credit spreads. Now, if there's an exception, there has to be a rule or a norm, and generally we expect the exceptions to be the minority and the rule to be the majority. Proportionality, when regulators talk about proportionality, generally speaking, they are referring to small banks. And then finally, at the end, they suggest that some banks might have difficulty decomposing these spreads, suggesting that other banks, actually most banks, would not. So there's the way in which they have written this leaves some area of doubt as to whether this is an option that is open to all banks, and whether they expect most banks to try to decompose spreads as set out in this graphic. So the EBA guidelines have really been controversial in two respects: the definition of credit spread risk as exposure to systematic spreads, which we've just discussed, and then finally the scope or the coverage of credit spread risk in the banking book. Now, the overwhelming industry view is that credit spread risk should only apply to fair value credit spread items, and that bonds account for virtually all of this risk. This is confirmed in an EBA survey of 48 banks in 2021, and that survey found that these banks viewed their bond books as the source of more than 90% on average of their credit spread risk in the banking book. Oops, sorry, I'm going backwards here. The EBA basically defined credit spread risk as all spread risk arising in the banking book, regardless of whether it is accounted at fair value or amortized cost. So basically, what the EBA says is institutions should not exclude any instrument in the banking book from the perimeter of credit spread risk in the banking book ex ante, including assets, liabilities, derivatives, and other off-balance sheet items, such as loan commitments, irrespective of their accounting treatment. And essentially, any potential exclusion of instruments or products or line items should be done in the case of the absence of sensitivity to credit spread risk. So in other words, banks will start with the balance sheet of the full banking book, work through it, and only exclude those items where they can demonstrate to the regulator there is an absence of credit spread risk. It's not a case of whether it's fair value or accrual accounted. So basically, EBA requires that assets and liabilities accounted for at amortized cost and deemed to be spread sensitive should be incorporated into NII simulation, and that measures the risk that they will refinance at adverse spreads, so at lower spreads in the case of assets or higher spreads in the case of liabilities. Now, basically, much of the industry concern in relation to that directive from the EBA was, how do we apply this to retail and business products? And essentially, the industry has argued that retail and business products are not exposed to credit spread risk in the banking book, because even if they are priced at a spread to a benchmark or can be expressed as a spread to a benchmark, they're not the same as wholesale market determined credit spreads. So, for instance, within Europe, many countries will write mortgages, euro mortgages, priced at a spread to Euribor, or indeed fixed rate mortgages that can be swapped to a spread to Euribor or to the Euro Overnight Index, Ester. Now, these spreads actually reflect factors such as pricing power. They reflect competition in the mortgage market. They may reflect tactical pricing. They may reflect teaser pricing. And all of this is really business risk. It's not credit spread risk as we would conventionally understand it. So even though it looks like it's a credit spread, in reality, economically and commercially, it is not. And that's the argument that banks have made. And this indeed is the argument that's made in the European Banking Federation paper of July 23, that the issue here is not whether you can express a retail product as a spread to a benchmark, but whether that spread actually moves in line with market spreads. If it doesn't move in line with market spreads, it is not credit spread risk in the banking book. Now, on that logic, you would think that only high-end syndicated lending, perhaps specialist lending, such as project finance, would qualify as accrual account with credit spread risk in the banking book. The results of the new ECB credit spread risk reporting, quarterly reporting, will tell us, assuming it's published, or at least published in summary form, how banks have interpreted the EBA requirements, what proportion of their balance sheet they have included or excluded in credit spread risk in the banking book. Some of the other concerns that banks have is most banks allocate capital to the fair value items that they think of as credit spread risk in the banking book under ICAP. But it is unclear if the EBA, certainly though the EBA expects banks to set capital against this, against credit spread risk in the banking book, but it is unclear if the EBA expects accrual accounted spread risk to be subject to a Pillar 2 capital charge. And banks have argued strongly that that's not the case because, as we outlined in the previous slide, banks would regard these spread movements in the retail and business part of the balance sheet as being business risk that is already factored into ICAP. And then finally, consistency. Other regulators, as far as I'm aware, have not come out with guidance on credit spread risk in the banking book. So there's clearly a risk of multiple and inconsistent regimes internationally. So banks that are internationally active could, for instance, be applying different credit spread risk in the banking book requirements in different parts of their business, or they could be competing with banks that are on a different capital regime for credit spread risk. And this could, for instance, affect pricing in areas such as syndicated lending, which could be quite significant. We mentioned new ECB quarterly reporting took effect in December 23, and it tells us how banks will tell us, or certainly tell the ECB how banks have interpreted the EBA's requirements. I'll just very briefly summarize some of the high-level elements of what the ECB is collecting. Essentially, based on the balance sheet, banks report to the ECB the volume of each line item in the balance sheet that is subject to internal credit spread modeling, whether that is fair value modeling or NII modeling. They report the sensitivity of each line item to the bank's IMS spread widening. So IMS being internally modeled. So essentially what they do is to say, banks, we want you to take your number for the credit spread exposure or the credit spread sensitivity of each line item and express that in terms of credit spread sensitivity. Finally, the definition of credit spread used, whether it's systematic or whether it's systematic plus idiosyncratic, in other words, total credit spreads. Again, banks have to indicate that. And then finally, the internal measurement methodology that banks use, whether that's scenario analysis, parametric bar, historic simulation bar, must also be identified on that quarterly report. So really, even though it's a quarterly report, in many respects, it resembles a QIS. What is the full form of IMS? I'm not 100% sure I understand the question, Sujata. The template, if you want to look at this in detail, the template that banks use is available, it's published on the ECB website, so you can certainly look in detail, and they also have quite detailed directions on how to complete the template. So if I suspect that's your question, and I think that's probably the best place to look. What I've done here is really at a very high level just summarize the high level principal items that form part of that report, the quarterly report. So what are the lessons? I think it's likely that non-European regulators will issue detailed guidance and direction on the governance, the measurement, the management, the capitalization, credit spread risk in the banking book. The guidance in BCPS, which, as we said, is simply in a few statements, is too light on its own. So it's going to be a consultation process. Banks should point out that the Basel definition of credit spread risk is very difficult to implement and likely to lead to inconsistent measurement across banks. And that banks should have this EBA style opt-out to measure credit spread risk with respect to movement in total spreads. Credit spread risk should be confined to fair value spread line items, particularly for ICAP purposes. Now, if the regulators follow the EBA's example, they say, no, credit spread risk includes NII items. Banks should clearly make the case that only line items whose spreads are driven by market spreads should be part of credit spread risk in the banking book. And as we said, this would probably bring corporate, or it would only bring corporate, particularly syndicated lending, into the net, but would exclude retail. And then finally, the exposure of NII to accrual account spread changes should not be subject to a capital allocation. So I would suggest those are the sort of arguments you should put to your regulator if they produce a document in this area. I mean, yeah, those sort of arguments to be made. And so then from a corporate perspective, you know, if banks have to set additional capital against accrual accounted credit spread risk in, for instance, corporate lending or syndicated lending or indeed specialist lending, it could have implications for loan pricing. Certainly, you know, major corporates. That's an argument that major corporates could also make if they wish to comment. So that's pretty much what I wanted to say. I'm happy to take any questions. If I can answer them, I will. If not, we can always post an answer on the forum, or indeed, if a question strikes you after this evening and you want to put it on the forum, I'll try and deal with it. But happy to take questions now. I realise we're into the evening, so you probably don't want to prolong this too much. Okay, I would say that is probably it. Thank you for dialing in, and I hope you got some benefit from it.